The overall cryptocurrency market cap is down to $1.2 trillion, its lowest in almost a year. At $29,000, Bitcoin, the world's largest cryptocurrency by market cap, is down over 50% from its all-time high of $69,000. Except for a brief run to $47,000 in March, the crypto market has pretty much been in the red all year long. But the crypto market is not the only market in the red compared to last year's performance. At only $4,000, the S&P 500 has declined by over 16% year-to-date. Nasdaq has also fallen over 27% year-to-date and over 30% within the past 6 months. Though gold seems to be having a better year compared to its performance in the past decade, its 30- and 60-day charts tell similar stories to the cryptocurrency and stock markets. While the lunar crash might have partly influenced the sudden fall in the crypto market, many indicators show that we were heading right here to begin with. Even if the attack and the subsequent crash did not happen, we still would have found our way here. It just might have taken a little bit more time. In this video, we examine all the facts surrounding the 2022 global market crash and how investors can operate successfully within such environments. Please watch, share, and like the video. And don't forget to drop your comments and observations in the comment section below. Thanks, and enjoy. One of the most obvious causes of the crash is the interest rate hikes. On May 4, the Federal Reserve increased its federal funds target rate by 50 basis points, the largest one-month rate hike since 2000. The crypto market's reaction to the central bank's announcement was almost instantaneous. Bitcoin lost over $3,000 of its price in less than 24 hours after the announcement. The decline continued, and by May 9, the leading crypto asset was down to just $30,200, its lowest price since July 2021. So why did the FOMC's announcement have such tremendous effects on the financial markets? There are several reasons for this. One, higher interest rates mean debts become more expensive. People have to spend more money to pay the interest on their debts. Without the interest rate hike, the extra fund would have gone to increasing their investment portfolios, which would encourage price hikes. In addition, higher interest rates draw money from the stock markets to interest rate-based investments that pay out the new, higher rates. So more money moves away from certain markets to others. Both of these points are very important, but probably won't have as much impact on the market as fear. Even before people begin pulling money to service their more expensive debts or towards interest rates-based investments, the market expects that sort of behavior and reacts accordingly. This brings us to our next point, which is reduced federal spending. During the pandemic, the central bank went on a spending spree to reduce the effects of the lockdowns on the economy. It bought up everything in sight: treasury bonds, mortgage-backed securities, and corporate bonds. Now the Apex Bank and the federal government are going in the opposite direction, trying to clean up some of the mess they'd made in previous years. Though you might argue that it is too little, too late, the quantitative tightening policies will have a lot of adverse effects on the market, at least until the economy improves and everything eases a little. When you have the federal government go from being the biggest buyer to being the biggest seller in a little over a year, the markets will certainly feel a pinch. And we must remember that the central bank has a $9 trillion balance sheet to roll off in 2022. Add that to the interest rate hikes, which also impact the government's debts, and we get a clearer picture of why the market is the way it is. We must also remember that amidst the high inflation and quantitative tightening, several aspects of the economy are still reeling from the effects of the pandemic and the subsequent lockdowns. We still have to deal with quite a lot of supply chain issues. There are still hundreds of cargo ships stranded in Chinese ports. Not only will this increase freight costs, but it will further inflame the already uncontrollable global inflation. And there is also the issue of Russia, which in addition to stopping exportation from its ports, has closed down Ukrainian ports for grain exports. Both countries account for around 30% of the global wheat exportation. They are big players in the exportation of other staple grains like corn. Now, this might not be a big deal if we are all not almost literally feeding from hand to mouth. The world depends on the timely exportation of these grains. If it doesn't happen, tens of millions of people will starve. Here is an excerpt from a Washington Post article showing the severity of the situation. The article quotes David Beasley, the head of the United Nations World Food Program. The ports are critical to food security globally, Beasley said. It will be catastrophic if we don't have those ports opened up and moving food supplies around the world. The impact of the blockage will be felt in both rich and poor countries, and it is already affecting market volatility. The war has driven prices of wheat, cooking oil, and other commodities to record highs, and the U.S. Department of Agriculture projected global wheat supplies would fall next crop year. So between the record high inflation in the United States, the United Kingdom, and Canada, China's lockdown, and Russia's war, the global economy is pretty much on the verge of a collapse. Most importantly, all of these macro and geopolitical issues point at one thing: the imminent threat of a global recession. Interest rate hikes have caused economic downturns in the past, and there is no reason to believe that this time will be different. The United States GDP has already had a 1.4% decline. If we have another one, possibly in the next quarter, the economy could continue to spiral down from there. So instead of asking why the markets are down, maybe we should be considering the possibility of further declines, especially if any of these issues worsen. How do investors proceed? Regardless of unfavorable market conditions, wise investments remain one of the fastest ways of doubling your wealth. The reverse would be asking you to save fiat currencies, which is certainly not advisable. So stick with your highest conviction assets and choose an investment strategy that doesn't expose you to more risks than you can handle. If you are a long-term cryptocurrency investor, it is better to focus on the long-term prospects of the crypto assets you have invested in and ignore the noise. There is no doubt that the cryptocurrency space is here to stay. In the long run, the 10 or 20% decline in prices won't matter. Apart from the reasons that have been stated, what else do you think is responsible for the market declines? Please drop your comments in the comment section below. We would also love to know the investment strategies you have decided to adopt as the market continues to battle these issues. So keep those comments pouring in. And don't forget to give this video a thumbs up and subscribe to the channel. Thanks for watching.